We are tracking shares of Canadian Apartment REIT. The stock is moving a little bit higher after it posted better than expected earnings results. This is a big landlord of apartment REITs, as the name suggests, across the country, particularly in areas like Ontario, Quebec, and BC. But it does have a presence all over, as I mentioned, in provinces like Nova Scotia and Alberta. And in part, it has been benefiting from increasing rent prices, something that many have looked at as part of the affordability equation. The CEO on the conference call acknowledging that this is the worst housing crisis that Canada has ever seen. Let's bring in Mark Kenney, President and CEO of Canadian Apartment REIT. Thank you so much for joining us, Mark. You know, in some ways, your sector is one that Canadians do love to hate. And I want to kind of get this out of the way. On one hand, you are acknowledging this is a housing crisis, what we're seeing, the supply crunch. But on the other hand, you know, I'm looking at your rents. They are going up, you know, by 6.5% year over year. So you're also increasing rents on the tenants.
Yeah, and this is a great topic. I'm glad we're starting here. One has to remember that the average rent at CAPREIT is $1,552 a month. So a percentage, like you've just quoted, on a very small number isn't very much money at all. And I think what a lot of folks get confused with is in the media, there's a lot of stories about existing tenants having their rents dramatically increased, where at CAPREIT, because we're a purpose-built rental owner, we're regulated in most of our markets. So for example, and this is a fun stat, we believe that our rents in Ontario have actually been going down because when you take into account a couple of years in COVID of zero rent increases on your renewal and then a capped rent increase of 2.5%, one might say that's well below inflation and effectively rents are going down. So a lot of confusion, I'm going to say, in the general understanding of rents, but we're very, very proud of how affordable our rents really are, and it really represents exceptional value.
Well, to that point, the numbers do back it up. On renewal, your rent growth is only about 3%, whereas on turnover, when people leave and you have new tenants, you're able to increase it a lot more. But it looks like, in the numbers at least, that fewer people are leaving their apartments, right? Because they do want to take advantage of the lower rates.
Well, you know what? I'm going to say these poor folks don't have a choice. And this is at the heart of the housing crisis. There is nowhere to go. So what we're seeing in our portfolio, and our peers are seeing it, is that because people have nowhere to go, there's a dramatic drop in the number of residents moving out on an annual basis. So big picture Canadian statistics, CMHC, 40-year average, you would see apartment buildings having about 35% of the residents move out every year, and those numbers have crumbled in the case of CAPREIT down to about 12% per annum. So a lot less people moving out, a lot fewer rents going to market, and most people protected by below inflation rent increases.
In some ways, though, as a business owner and a business leader, are low rents a double-edged sword? Because you also want a situation where we want builders like you, or owners, I should say, of assets to be incentivized to increase supply. And in order to do that, you have to feel like you're going to get a return.
Absolutely. And we're striking that balance. So part of getting there has been CAPREIT has been selling our non-core assets, and these are the assets that are traditionally in the most affordable segment of our portfolio, and using those funds to invest in new construction apartment buildings to help stimulate supply demand in Canada. So in many cases, and we've just done some recent announcements, we would love to see our most affordable assets end up in the hands of nonprofits, where those nonprofits can preserve affordability in distressed income neighborhoods where people really need the most relief. And that's where I'm going to say the stories in the media are the loudest, and where we think it's a perfect partnership between government and the private sector to do this. Now, I got to also add that there's protection funds that have been launched in both BC and federally, And the acquisition cost of these buildings is about 60% less, if not more in many cases, than building new affordable supply. So it's a way to get there very quickly for Canada. Another stat that is embarrassing for our country, we have less social housing per capita in Canada than our US neighbors. And I find this to be incredibly embarrassing for a country that claims that it has a social conscience and has government policy aimed that way. So we have to catch up fast.
And you say part of that solution would be, you have assets that you're willing to sell. You need, that the government or nonprofits could step in to buy those.
That's right. And then take those funds and reinvest it in new supply.
That is how they have been affecting, and to your point, that has happened a little bit already. That's kind of affecting on the supply side. One of the measures was also on the demand side, moves to curb immigration. And I'm wondering if you're seeing the effect of that on the ground where you are.
Not even close. And I got to tell you, a day doesn't go by now where people aren't talking about tent cities getting bigger in Canada. We're in a situation where, our under 30s don't live alone anymore. There's roommating. There's under 30s living at home. It's really a dire situation. And if the complete immigration pipeline would be to stop, we can't catch up with the lowering supply that we have in the country. Higher interest rates, inflationary costs. Our traditional new supply in Canada is falling at the same time that we're fighting the greatest crisis of housing demand that our country has ever seen.
Why is it falling then?
The cost of building, it's not economical. Getting permitting from local government, having the infrastructure to tap into it, the cost of land, the list of headwinds is enormous. It's not a silver bullet situation. And what I say quite often, just to get attention, is that it takes 20 minutes to process a family for at Pearson, and it takes 7 years to build their home. Okay? That is the traditional life cycle now of building multifamily in Canada from beginning to end. And that 7-year cycle is on pause right now in large form because construction has become a real problem for builders, and the risk is even higher.
And for your business, you mentioned you are trying to get greater exposure to those new construction bills. I think that's now about 11% of your portfolio, which is up quite a bit over the past couple of years. Where do you want to take that? Where can you take that as a percent of portfolio?
Well, we've disclosed that in our portfolio, we've identified about 22% of the portfolio to be non-core and open to disposition. We're not rushing to get there, but we've identified what we think are non-core assets that kind of meet the target of what we want to do, and we'd like to recycle all of that money into new construction.
Lastly, you want to recycle all of it. That was going to be my final question, questions about, is there competition for those dollars, whether it's on your distribution, on buybacks? So all of the proceeds you want to funnel into new construction?
No, I actually misspoke. When it comes to the type of housing we want to own, new construction, but we also have very compelling use of those funds to pay down our revolver debt or to buy back our shares, as you just said. We've been actively doing both, and we'll continue to do that as we're able to sell assets. What we won't do at CAPREIT is lever up, but when it comes to the new housing that we own, rental product, it will be primarily focused on new construction apartments.